Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, January 21st, 2026. It is 9:49 a.m. Eastern Time, and I'm going to do a quick video here. I'm going to start out very briefly with what to watch today. I'll try to keep it as simple as possible. I won't get into all Mag 8 right now because I've covered those in detail recently. You have the levels to watch. But to keep it, again, on a very simplistic view today, just look for a break between the recent lows. We have sell signals. I still expect more downside in the coming days to weeks, regardless of any counter trend bounces. Because of those sell signals, including the breakdown of the trend lines yesterday, pretty solid. Any bounces back to resistance, in my opinion, will provide objective short entries or add-ons. So again, you can use this is a daily chart. You can get on the 60-minute charts to kind of hone in, on the little micro levels, I like to call them, and look to short bounce back to resistance. Like there yesterday, that was about that 614 level. That's still resistance. There's a big gap there at the top of that gap, and just based on where everything is at, and just looking at this trend line, you don't want to see a back of the test of the trend line because that could take a while to do so. And so really I would say up to, but not much above that level. I would just hold off at that point, and then I'll address it if we start to get above the top of this. Again, yesterday's big gap, I'll address my strategy as far as whether or not I think it's makes sense to scale out or just close out short positions. But as of now, first things first, we're on sell signals and with more downside likely. So we'll just leave it at that and adjust and adapt if and as necessary. Here's SPY, the S&P 500. Same thing yesterday. Remember, in pre-market, we were down lower, opened up a little higher. There was a rally in pre-market to open right on that 681-ish support. Bounce back to that first resistance there, 684. Your next resistance around 680, almost 687, a little shy of that. You have that reaction low, and then the big old gap right there. So that's what SPY looks like. And again, so anything up to but not above that level. I'll maybe later today get a little more micro again, looking at the Mag 7, but or Mag 8. But the other one I wanted to cover for today, keep an eye on, is the financials. As I said, we're not going to get a real party to the downside going until the financials, clearly continue lower. Remember, we've already had the failed breakout. Like I addressed it yesterday, it's not unusual. This was the breakout point. This is where it failed. A little bear flag action broke down. And so if that bear flag is going to play out, again, ideally it needs to do so in a somewhat impulsive manner. So in other words, this green we have right now, nothing big, about 0.86. That's a run-of-the-mill move for financials. They need to fade that and then take out today's lows. So I'll make it very simple. A break of today's lows would also, in both the financials and or ideally in all three, SPY, QQQ, and XLF, would, in my opinion, provide an objective add-on or new short entry. And again, rallies back to resistance. We don't have to have the bear flag play out. But if it's going to, we don't want to see a big move up like that. It would be atypical of a bear flag pattern to have a impulsive breakout like that and then a big snapback to back test the flag. Either way, again, just watch for today's lows. So let's move on. What I wanted to cover in the rest of the video before I get to the Netflix trade idea, a longtime subscriber posted a great question, a lot of points in there, and it triggered other things I want to share. So I'm going to get to Netflix and share my thoughts, not just on Netflix. It's only one of many, many trade ideas, so I'm going to get to that part. But more so, it has a lot of little nuances I want to cover. I strongly believe 2026 is going to be a lot like the last quarter or 2 quarters in 2025, which is very much a stock picker's market. And that's where technical analysis shines. For those who've been frustrated because the market just goes up, and why don't I just have my money in an index fund? Trust me, those trends never last forever. And I may certainly be wrong, but I believe it will continue to be as it has been. Again, if you look at all the trade ideas on this site, the last, go back last year, go back last quarter, last 2 quarters, 3, 4, you will see stark outperformance of the stock market, especially, like I said, the market's gone nowhere. You can see XLF, for example. The financials, who've been one of the strongest sectors over the last couple of quarters, today, as I speak right now, are trading exactly where they were as I move my crosshairs over about 6.7, almost 7 months ago. So we went down a little, we went up a little, we went down a little, we went up a little, made a new high, and now we're back to where we were again, approximately almost 7 months ago. And again, I'm picking on the strongest sector. I can pick a lot other sectors that are down. So if you want to beat the market, you can do so if you only trade the market and you have very sharp skill sets, trading the indexes long, short, or you can do it the easy way and go long the most bullish individual stocks and sectors, short the most bearish, also introduce other asset classes, commodities, crypto, all that in there, and do the same thing. Long the most bullish, short the most bearish. All right, let's move on to treasuries real quick before I wrap this up. TYX is the yield of the 30-year yield. I have a 15-minute delay on this particular chart, but I track it on other screens. And either way, I covered it yesterday. Breakout, little abatement so far today. The comments from Treasury Secretary Bessent yesterday in regards to Treasury yields going up, he was completely dismissive. It reminds me very much of Powell back when inflation was ripping. We all saw, well, some of us saw it. We saw it here, long commodities, making the case, and anybody that went out and did their own shopping. I had a theory, Powell and the likes, probably have personal shoppers. They have no clue what groceries are. He probably just signs the bill at the end of the month. And, so the rest of the world saw new inflation was on fire, and he dismisses transitory, not a problem, until all of a sudden it was. And then they had to start hiking rates and put on the brakes and had his little mea culpa there. All right. So, and Besson, again, now, one of two things. Either he is oblivious, as Powell was, to this rise in yields and what it could mean. I can't emphasize the importance of the U.S. economy. We are completely dependent to finance, pretty much keep the lights on, Social Security payments and Medicare and the defense and all that other stuff. We're dependent on borrowing. All right, we are a debtor nation, and either way, this is very important and should not be dismissed. So again, either he is kind of clueless, or maybe he's doing what a lot of politicians will do, downplaying something, meanwhile freaking out, sitting in his chair right now, praying and hoping this stops. So, what happened yesterday as well, if you're not familiar, this is the Japanese 40-year bond. You can only go back. I've pulled a couple charts. I guess they started issuing the 40-year. We only go out now to a 30-year bond in the U.S. We used to have, I think, at one point a longer, 40 or 50. 30 years our long bond. And Japan issues this 40-year. It's just been going through the moon, and that's no bueno. Remember, Japan's one of the G7. It's not a small. It is a first-tier, country, economic superpower. And this is again on another charting platform showing you again. Must be because that's both charting platforms only go back to 07, and you can see this just going through the moon, and that is not a good sign. And again, so we'll see if anything similar happens to the U.S. It would be nothing short of, I believe, catastrophic. Again, you've got the short-term rates being cut, and that has nothing to do. We don't sell our 30-year bond, our 10-year bond, even the 5 years I covered yesterday broke out. And that's where the borrowing costs, or at least a big part of it is, to the U.S. and to the consumer. You, I, your neighbor, nobody, unless your neighbor is Jamie Dimon, nobody borrows at the federal funds rate. That is a overnight lending rate for banks. That's what the Fed cuts. And literally overnight, like one day rate, not even 24 hours or 24 hours or so, whatever that is. Most of us, if you have a mortgage, that's pegged roughly to the 10-year Treasury bond, even if it's the 30-year mortgage. You have a car loan, business loan, those are going to track anywhere from 5 to 10 year rates. And so what happens on the longer end, especially for our country. I'll get off that now. You guys understand the importance if the Treasury loses control. The Fed has already lost control. I've made that case, the long end of the yield curve, but it's not at critical yet. Critical will be, in my opinion, when the 30-year bond breaks out of those recent double top highs we put in the last few years. So again, something to watch. And again, particularly with the U.S. Treasury bonds and then the lows on the indexes. All right, let's change gears. Let's go over to let's talk a single trade. But again, I usually don't do a video on a single trade idea. But this one, let's get to that. Here's the question. So I'm going to read the question and then I will reply. And again, the takeaway is more so I'm trying to convey how best to utilize the trade ideas. What I'm doing here. I would be the happiest man in the world if every subscriber to this site had a banner year, vastly outperform the market, whether the stock market goes up, down, sideways. That is my goal for 2026, and I'm gonna do my best to kind of go over all the little nuances and just continue to reiterate what I've always said is diversification, asset allocation. Those things to me are every bit as important in active trading and swing trading as they are in long-term investing. Spread your bets. I've always said this. I make a lot of yogiisms up or little sayings in the market, and I repeat them often. And one of those that I've come up with years ago is about the only guarantee I will give you as a subscriber to Right Side of the Chart is that I'm going to be wrong, and I'm going to be wrong a lot. Therefore, what I do personally, and I highly suggest everyone, is spread your bets. Don't put all your money in one trade. I might be drooling, foaming at the mouth, bullish on a certain trade at any point in time. But guess what? Even the best looking setups, even if the fundamentals and technicals line, they don't always play out. There is nothing guaranteed in this game of investing trading other than nobody bats 1,000. That's about the only guarantee you're going to get. So, therefore, take trades, even if they're, you're like, Randy, you're trading soybeans. I don't care about soybeans. And I'm not picking that one. Just for example, you spread it out. Especially as I'm going to get into NFLX, is some of the takeaways from that one trade. So here it is. So I'm going to read this out. Hi, Randy, longtime subscriber and fan of your work. I have a question about this trade setup and the strength of it. Not to question it, but to understand your thinking and learn from it. I think I've learned a lot from you, Bubba. Okay, let's get to the, I appreciate that, by the way, but let's get to the question. So I see a drop to support, possibly bullish. Well, I'm going to just break this apart. I mean, not in itself, the opposite of that, honestly. A drop to support, and again, I'm getting very technical. This is nothing but bearish. This stock is 1,000% in free fall. I am 1,000% trying to catch a falling knife here. Yes, you try to catch a falling knife, you can often get cut, and you can even lose a few fingers in trading and investing if you don't use stops appropriately. Because I've tried to catch many, and I do that all the time. If you follow me for a while, you know that most of my trades, probably the majority, are top and bottom calls. Things that most people don't do, and I've heard over the years, honest to God, dozens of people come out on Bloomberg and CNBC and say it's impossible to catch a stop or a bottom in the stock, and it's just my style, and I think I do it very well. And again, if you follow me for a while, you'll see a lot of those trades, and they all don't play out, and that's what stops are for. So I take those shots. Again, it just happens to be how my trading style evolved, the type of patterns that I like to recognize, instinctual feel and experience of which stocks are going to bounce off of support, when it's time to step in and start buying support when something's falling, and when it's time to sit back and either not buy or wait for that support level to break to short the stock. All right. So that's just want to say this is NFLX is nothing but bearish right now. A few weeks from now, a couple months, we could look back and say, wow, look how bullish that was, that hammer off support, bullish engulfing candle, any other type of, bullish reversal pattern. But okay, I made that point. Bearish now. I don't see any divergences on the time frame. Actually, there are. I'll get to that in a second. I only showed you one chart, and I do look at multiple time frames. Potential flag pattern. Developing after hours, bearish, with the markets also confirming sell signals today. I'm curious as to what else you see to support the bullish case. And that's it. So I asked not as a perma bear. Took a long position. Dow Jones. Of course, it's starting to look like a bear flag as well. So time will tell. Okay, so I think I covered all that. And like I said, there's too much for me to type in here. There's a limit on how many characters can be in a reply on the software here. I'd have to go in and change all that, or I'd have to sit here and type for 20 minutes. So I'm just going to rifle off real quick. And I have a little notepad here so I don't miss any of the points that I want to cover in Netflix. And again, one of many trades. So let me just start there and just say that. It's one of many, many trades. It either works out or it doesn't. It's not something I would ever put all my money in, nor would I do that in any one single position. So that's it. It's take your shots. Trading is a numbers game. And the more you spread out your bets, the more likely you are to succeed. Think of it like Vegas. Think of it. I'm not a gambler. I do not like casinos. It's not my cup of tea. I know the odds are against me, and I can't control that. I can control odds in the market when I trade. But it's like walking up to the roulette wheel. Well, you put it all on black or red, or even or odd, or double zero, whatever you want. You're going to either, it's going to be either pay out pretty nicely or you're going to lose everything. However, you sprinkle some money on, again, and I'm not a roulette player, but the more numbers you cover, the more if you cover red, green, red and black, right, and then greens I think are your zeros, you're spreading your bets and you have a higher chance of winning. Yes, the payout's not going to be as high when you do that. However, if you want to hit home runs, go find a service out there that trades penny stocks. Those are usually pump and dump schemes, anyways. But that's not what I'm doing here. All right, so it's diversification. All right, so number one, this, as I just tried to impress upon the point, it's one of many trades. It's part of just trading diversified, and I'll get to why I like the trade here in a second. It is also on that a hedge to current shorts. As you know, as I've covered, we've recently had sell signals. We had sell signals earlier. Yesterday were additional sell signals. I made the case that some more of the, we had a couple more check marks on the market leaders. And being short on the market, this trade here also goes in line, if you followed me for the last few months, pretty much the better part of last year, I started stating my preference for long side trades. I got away from favoring continuation patterns, breakouts, things that breaking out to new highs, and doing the opposite, looking for beat down blue chip stocks. And there's been a lot of them. I've covered that throughout last year. The percentage of stocks in both the NASDAQ and the S&P 500 trading above or below their 200-day moving average was below 50 for most of the year. So about half the stocks, even though the stock market kept making new highs, half the stocks were below their 200-day moving averages. Again, it was a story of very narrow market breadth. The Mag 8, Magnificent 8 stocks doing almost all the heavy lifting because they account for, depending on what index you're looking at, a third or more usually on the S&P or NASDAQ 100. So therefore, we did a lot of blue chip trades like Pepsi and there's a bunch out there. I hit them, move on to the next one. But and most of those worked out, and they worked out very well. And that's what this is. This is what I call a modern day blue chip stock. Remember, long before Mag 8, there was FANG, F-A-N-G, right? Those were the four powerhouse, the four horsemen that led the market, were the highest weighted on the indexes. And this is the N in the old FANG. Nobody talks about FANG anymore because Netflix, it's still a powerhouse. It is still a very large company. It's still a $374 billion company. So that's no small thing. It's kind of dwarfed by the mega, $3 trillion club companies that have evolved with the AI bubble. All right, so there's that. Okay, so again, it's what I would call a modern day blue chip stock. The old Ma Bells, AT&T, and General Motors of yesteryear. Those are long since no longer the darlings of Wall Street. They were back when they were in the Nifty 50 and all that other stuff. So times have changed. So okay, I think I've made that point. Netflix is here to stay, at least for the foreseeable future. So I don't want to beat a dead horse, but I want to tell you this is the type of stocks I'm comfortable with. Do you want to buy Netflix here, here, here? When you're extremely overbought, you look down below, you see these indicators, overbought with divergences right here, 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 with abysmal RR, meaning risk-reward profile, your upside potential compared to the downside risk? Or do you want to buy here, where we just did, after one of, again, the former FANG, one of the, in the not so distant past, one of the four largest and most powerful stocks out there, has fallen 39%. I will take that trade all day long. I will take a stop out and get right back in it. And I'm going to show you where I will if I am stopped out on this one. So I also want to point out this right here is the most overbought reading that we've had since right here. I'm going to put a cross here. I'll draw a line, make it very clear. Take a line across. This is the RSI here. I'm making a parallel line, and that was it. So the last time we were this oversold, the stock went up, before all said and done, 734%, right? We also had some divergence at that low, and all the reasons to cover and go long, which we're doing in the market at that time. That was, at the end of that tail end of that bear market. And also, and again, this is why I do this, I can convey so much more in the video than I can in the post. If you'll notice, okay, so I just said that last time the stock was this oversold, it went up from there, really with, minor corrections relative to the scope of the move, 730 something percent, right? Okay, then why am I only targeting, and I told you yesterday, my preferred right now, and this may change, my preferred target is T1, which is only, quote, it's relative, about 13% pop, if I get it right. I added a line here, by the way. If anybody that takes it, you want a quick gap fill. I have a high degree of confidence in this trade, by the way, guys. Unless the market melts down. It's one of my favorites at this point in time. Yeah, quick gap backfill. If you bought it on support last night or this morning, you still had plenty of time this morning. It didn't do anything overnight. Open about where it was. That's a quick 5%. All right, and one of the many terms I've come up with in trading over the years is a term I call velocity. And what I mean by velocity, it's why I like swing trading. If you make 5%, in this case, it'll probably be hit today, in my opinion. 5% in a day. Let's just, for shits and giggles, say it takes about a week to hit that gap backfill, assuming the support holds. Okay, 5% a week. There's 4.3 weeks in a month on average, but we'll just say 4 weeks in a month, or 52 weeks in a year, right? Annualize that out. You're destroying the market if you can get a quick 5% and get out. That's velocity, because then you have that capital to redeploy on the next trade. So, if you do 5% a month, you're making, not compounding it, you're making 60% a year. Right, so there's that, and that's what swing trading is all about. Sometimes I like to hit singles, quick singles, get out, doubles, and then sometimes I like to hit home runs. So back to where I was going. So why now? Okay, if we're the first time we're at such extreme oversold readings that we haven't seen since this bottom, am I only looking for that, which is a relatively much smaller move, because I believe it is. It aligns with where I think the markets are going, and I'm just looking for a bear market rally. I'm looking for a reflexive bounce off support. I'm looking for an oversold rally, short covering rally, all of the above. And so therefore, the way this works, that's your first price target right there. Really, if you want to do that, I'll tell you right now, if you want the quick buck, it'll probably be a reaction. Then if they take out the gap, that's bullish. And especially this downtrend line right there, that's going to sharply increase the odds we go and hit T1. And, I'll let you know, as I often do, if and as we approach T1, if I think there's a good chance we're going to hit T2. A lot of that will depend on how the broad market's looking at that time. And if this one really gets some traction, I could easily see it if the market holds up and doesn't go down and hit my T2 or especially take out T2 on QQQ, my next target on the daily, then we're probably going to run up at the 200s, right? And that's going to be a bounce of, and it would still just be a bear market rally, but it'd be about a 30% bounce in Netflix. And I think that's very likely. And I'll even tell you now, I'll just tell you that's a potential third target. Potential because to be determined. I'll have to see, do the broad markets hold support? Do they rally? Do they want to make new highs? And so there it is for you. And that's really potential T1 if you want the quick buck. All right, so let's go back to my little scratch pad here. I kind of talked about the oversold readings, to address the time frames here. I haven't updated this chart, but I just looked at it last night. I'm going to draw it for you here. Netflix has been building nice positive divergence on the 60-minute time frame. As many of you know, that's my probably my favorite go-to swing trading time frame, and that's powerful positive divergence. From this point, you have prices making lower lows versus the indicators, both the RSI and PPO, making higher lows. And so, boom, pop that trend line. Again, it's an older. I haven't updated this chart in a while, but I'm going to show you a couple of other things here. So, another reason that I liked it here. Some of you might recall, if you were back here at the time, back in May, actually, where was the first? Yeah. In April, I gave a setup on Netflix. I had an uptrend line here, and some divergence building, and a sell signal to come on a solid break-in or daily close above that uptrend line. And then we got it just a day or two later. This is let me squeeze this in so you could see it. I'm just pulling those charts I posted back then. Again, this was last year. There's my daily chart. Sell signal was triggered, and I had it coming down here, 821.67, right? And I also gave that at the same day. These are always time and date stamps, so you can see when these charts are screenshotted. I gave it to you here with all the targets on the 60-minute chart down to that 825.86 level. Okay, so that's where I have had a pretty good read, believe I had a good read on the chart, where this stock is going to go. And as you know, my final targets are often the end of a drop on a short trade, and I will often cover and reverse there. So that's 820, again, 825.86. That was then, this is now. This stock split right here, see that 10-1? So you just move the decimal over. That's the same exact support level. Now, where did that happen? That trade was stopped out, turned to be a whipsaw. It was a nice, clean trend line break, but this stock had more juice left in it. And it was a stop out trade because that proved to be a whipsaw, went down, never took out that breakdown candle low, and rallied on up. Now, it wasn't much. Like, somebody could have held this stock if targeting that final target. And from the breakdown point, I'll do it right here, measure up. From where it broke down, right, I have to go a little below, so I'll stop a little shy. It went up 17%. Then from there, it gave another sell signal, it dropped 27. So a little bit, really pushing the limits of a favorable RR. You don't want to risk 17 to make 28. Some people will. Some people trade a 1-to-1, but either way. And then it put in the sell signal here. And I did cover this in additional videos. I've covered, again, that was posted as a trade idea, but I stayed on Netflix, covered that, bearish rising wedge break, then this trading range in the primary uptrend line. This was a beautiful sell signal here. Again, covered on the site. Both the break of the trading range looked a lot like the stock market now, right? The uptrend line, and then the 200s were taken out afterwards, tested for a few months, and when the market saw that Netflix was unable to hold. There's a rejection candle after a month or two of testing the 200s. Rejection, one more attempted back test to recover from below, failed, boom, and that took us here. So again, we're at now exactly where I figured this stock was heading last year. This also aligns very, very much with my outlook on the market. For those of you who know, I've maintained targets from last year, long-term swing trend targets down to T6 or 7 on the NASDAQ 100 and S&P 500 that were hit. We hit the initial targets last year on that big drop we had. And then we covered at those targets, so cover shorts. We bounced. We made a marginal new but still divergent high in QQQ and SPY. And this is exactly where I kind of, we had some sell signals there. We made a newer high, marginal new, but still divergent, even a bigger divergent high. And all that did, that additional last leg up that extended the negative divergences, just set the way for an even bigger drop. Because if we would have hit it before, again, we would have had a 27% profit on that trade. But what happens? This went up, put in a bearish engulfing. Look at that beautiful topping action. Bearish engulfing, then the trend line break, and I went on to show you all the additional sell signals that came. But that laid the way for an even bigger drop of 38%, right? Off that high. And that's exactly how I view the stock market right now, right or wrong. But again, the takeaway is it doesn't matter if I'm wrong because we're going to trade. I put out a lot of trade ideas, long trade ideas. I probably put out more long trade ideas in the last 6 months to a year than I have short trade ideas. And those have, on balance, the vast majority were successful, hit one or more price targets or the final targets, and also vastly outperformed what the stock market's done in percentage terms. So that's how this is. So it's a hedge against index shorts because it's a long on a stock that tends to move with the market. But in this case, obviously, it was marching to its own drumbeat, oversold. All right, what other points here? Previous final target hit. So again, go back to those charts I showed you. Again, just adjust. Those are the same reaction lows there. And so this plays into it. And I didn't, again, last night I just wanted to fire that post off to you, but I very much looked at these old charts, in the current chart, and wanted to point out the divergences. It just gets too time consuming if I post and screenshot and annotate all different time frames that I analyze. On a longer term perspective, guys, and again, I'm speaking to one single trade here that either pans out or it doesn't. If it doesn't, I don't give it a second thought. It's going to hit the stop. I give you a suggested stop. We're out. If it doesn't hold support here, which is probably going to happen if the market craters and goes down 20% or more, right? Then we're probably going to come down through that support. And this is my weekly chart. This is my next support down here. I don't see a lot of support until then. And that would be another, we're at 82 on the weekly. That's about roughly $82 support we just bought at. That's another 16% drop. And look, longer term, this is bearish. This is a secular bull market uptrend line right here that was broken. And big negative divergent high. This is all predicted and forecasted or signaled, telegraphed, if you will, in the charts. And the 200-day moving averages. Look at those blue and red lines. On the weekly chart here, they say, and they are 40-week moving averages. It's the same thing as a 200-day on a daily chart. And here's Netflix. It was in a bear market back here. I mean, it's just, again, these are amazing. And I don't want to, for lack of a better word, calling it simple, because there is nothing 100%. But if you just sometimes take a step back, tune out the noise, all the bull speak on TV right now. I know just about every analyst is so bullish. Trump's deregulation and AI, and we're going to have a great year in 2026. Again, every stock is different. This one took out the 200s there after riding them up like a world champ, took them out, and a bear market came, big bear market. Then it took them back here, and a new bull market started. And every single time the stock pulled back to the 200s, they bought it, and then it was lost there. So that, to me, is a powerful sell signal. And this is a first wave down, and I'm just looking for a counter trend bounce. I don't believe this is a bottom in Netflix. It's a temporary bottom. Again, it's all semantics. That's all. So I don't think it's going to new highs, in other words, anytime soon. Okay, so that's it. I think that's about it. So I covered a lot of points, a lot of little nuances, and the takeaway is, this same mindset. If you can get yourself in that mindset of taking trades in different sectors, different stocks, they might not interest you. And everyone knows Netflix, but most of the trade ideas I put on here, especially individual stocks, nobody's heard of. And a lot of people, I don't get feedback and comments on those. And those are the ones that, especially in the last year, is, again, to reiterate, with the stock market, especially the leaders going sideways, nowhere, a buy and hold investor has gone nowhere in QQQ or SPY, the S&P 500, for months now. Back to where you started. But trade these individual stocks. Don't get married to them. Set it and forget it. You know me. I love OCO orders. They are the best thing since sliced bread to come to the markets because they provide two things: convenience for the armchair investor or trader. I sit in this chair all day, 5, sometimes 6, even 7 days a week when markets are moving. I'm working on weekends studying charts to get things out to you, and sometimes I'll even fire posts off on weekends or late at night or early in the morning if something is timely and actionable, and I'll get those out to you. But either way, what the OCOs do, besides the convenience for someone who's not in the chair all day like I am, staring at a bunch of monitors, you set it and forget it. And an OCO or OCA, some brokers call them, one cancels the other or one cancels another. Super duper simple. And again, this is a max stop calculated with a favorable RR if you're holding out for the final target. If you're only going for T1 or if you're only going for a gap backfill, your stop should be tighter relative, again, to your price target or targets. Maybe you're going for this, so you have a wider stop. Either way, OCO, you set 2 orders. You set a stop loss, good to cancel, and you set a sell limit order, good to cancel. Maybe you're targeting take half off there, the other half there, maybe all of it there, maybe all of it there. Again, good to cancel. And then only one of 2 things can possibly happen, guys. You're either going to hit your price target, in which case your broker will cancel the stop order if your price target's hit, so you don't have to worry about having it open anymore, or you're going to get stopped out and they will cancel your other order. And besides the convenience of not having to be in front of your desk all day, is the discipline. And that's where I've been doing this a long time. And hey, even I still suffer from time to time. I have to check myself. Discipline is where I think most traders fail. Some have the skill sets, good chart reading skills, recognize pattern recognition, recognize when a stock may be ready to turn or break out of a range, but yet they second guess themselves. And so the OCOs set it and forget it. Don't touch it unless something compelling comes up, very compelling, that convinces you should modify your trading plan. I'm not the most rigid trader, but at times I will change a trading plan. You see me do it all the time. Eliminate price targets if I think the end of the run is over, or extend price targets if I got into a trade and I think there's more meat left on the bone. So those are examples of me modifying an existing trading plan. Okay, so hopefully I did a good job. I was very wordy, but I had at least 8 bullet points there to get across to you as to and to answer that question. And again, I love those kind of questions because I do believe it benefits others, and to help you also get into my mindset of it's not randomness. And there is randomness and constantly throwing out trade ideas, but there might be randomness. You're like, oh, Randy, now you're trading. One day you're talking about corn futures, and the next day you're talking about crypto or live cattle or crude oil or natural gas or Mag 8, and sometimes you're bearish on the market yet you're bullish on this stock, which usually moves with the market. Why is that? And I just explained it. Here's a great case of one that didn't, while the S&P was making new highs here lately, and the NASDAQ wasn't too far from them, this former leader has been beat down, is on sale. So the risk reward, even if it goes down, which is a possibility, but in my opinion, pretty low probability, the downside's minimum. You get oversold. Think of it like a rubber band. The further you stretch a rubber band, the harder it's going to snap back. And so that's it. I'm going to stop the video here. I will put out some more coverage today. I'm watching the FANGs closely. The Mag 8, I'm sorry. Mag 8, financials, treasuries, and a gazillion other things. And I'll try to keep the trade ideas flowing. Maybe do some updates on some of the other stuff, crypto, metals, agriculture, commodities. So I'm going to figure out what to get out to you next. I try to do these videos and post updates on what's the most timely thing at the time. Even if I'm following something, if you don't see updates from me for days or weeks, it's because it's not doing anything. It's in a trading range, consolidating. But when I think it's time to move, or right before that time, that's when I try to get those updates out to you. Alrighty, hopefully you understand the randomness, if you will, of how these posts and videos come out. This has been Randy Finney with The Right Side of the Chart. Have a great day.